Afternoon, everyone. My name is Tim Hall. I'm the moderator for today's panelist discussion sponsored by the Wharton Club of the UK. It's in a webinar format on Zoom, which means you will only be able to hear and see the panelist. This is my inaugural webinar attempt on Zoom, so I'm hoping it will go without a hitch, but one never knows. The title today of the webinar is Investing in Uncertain Times. We're very, very fortunate to have four excellent panelists. I'm going to let them introduce themselves in just a moment. The format today will be a moderated Q&A, which will go on for 40 or 45 minutes, followed by a Q&A from the audience. You can send your Q&A, I believe at the bottom of your Zoom screen, there's a box for a Q&A. I will see the questions and will ask them on your behalf once we finish the formal part of this meeting. So with that being said, why don't we start with introductions. I'll start with the order I see them on the screen, which is you first, Graham. So why don't you or actually Petra, I'm sorry, that's not very polite of me. I should let you go first and then we'll go down the list. So please, Petra.
Okay, thank you. So my name is Petra Poznikova and I'm part of the investment team at VAR Capital. VAR Capital is a multifamily office and an asset manager, which was set up in 2012. And currently we manage money for about 35 families. And as investment managers, we focus on public markets. So our portfolios are invested predominantly in publicly traded equities and bonds.
Thank you. Graham?
Thanks. Yeah, my name is Graham Dewar. I currently run a company called Market Beta, specializing in ETFs and platform solutions. I guess for the last 30 or so years have been involved in the building and running of a number of high-profile investment platforms across multi-assets, but delighted to be here.
Thank you very much. Matt?
Good evening, everyone. My name is Matt Farrell. I'm an investment director with London and Capital. For those of you who are not familiar with L&C, we're an independent wealth manager. So we create solutions for families, individuals, trustees, incorporate strategic financial planning, portfolio construction, reporting. And we've had a dedicated team that deal with Americans. I've worked with Americans in the UK for over 25 years.
Okay, and lastly, I just realized that Alan, who was on the entire time we were warming up for this, has disappeared. Are you there, Alan? I can't see you.
Yeah, I'm here. Can you see me now?
Now we can. We have you.
Yeah, cool. Good evening, everyone. My name's Alan Higgins. I'm the CIO of Coutts, the private bank. So we're also primarily in the liquid space. We do a little bit direct private equity. Before wealth management, I had a 15-year career in institutional fixed income. So I came out of the bond market way too early, some 15 years ago, to do multi-asset class in this world of wealth management. And also I'm an advisor to a couple of families.
Thank you very much. Okay, so the first question, we have to start with, obviously with COVID-19 and the pandemic. And my question for you is, how did your clients react as we rolled into this pandemic, particularly in February and March? We've rolled out of it very quickly, of course, but it must have altered their attitudes toward investing and risk-taking and so forth. I'd be very curious as to your reflections on how your clients have handled this sort of very unforeseen event in the markets. Petra, do you want to start?
Yeah, sure. So as you would expect, it was a bit of a mix. Obviously, some clients who are a bit more experienced with the ups and downs of the market stayed relatively calm. There were some others who got a bit more worried, but overall and luckily, we haven't really experienced any huge pressure from clients to completely take money out of the market or change their mandates at the wrong time. But it's definitely been a learning time for at least some of the clients and also some of us who haven't really experienced anything like that in their career so far. So the attitudes have changed, and as you say, I think risk appetite has changed for at least some of our clients. And I would say there have been predominantly two lessons for both us and our clients. One is on the liquidity front, especially in fixed income. I think some of our clients in their other portfolios, but also in some of ours, we learned that liquidity can really dry up when things get tough and when the market becomes really volatile. So our lesson here is really to focus on the very, very liquid part of the market. So this is kind of what we have been focused on always, but it has become even more of a focus. And then the second lesson has been on leverage. Leverage, for especially the purpose of our type of portfolios, should really be kept low, if any. And that's something that some of our clients experience, not necessarily with us, but with some of their other portfolios, where they had to liquidate at the bottom of the market, where they had to respond to a lot of margin calls and lost a lot of money. So we are really convincing clients now to be conservative when it comes to leverage as well.
Yeah, makes sense. Alan, what about at Coutts?
So largely our clients have been stoical. Obviously there's been difficult times and we have had inflows, but every client's different. And, I've got some stories as others have. And it almost brings it on why should equity markets fall steeply in a recession when you always come out? Because if you do the maths on the cut in earnings to come, as we're going through it, it doesn't merit a 35% fall in equities, actually, and we can talk about that later. However, as always, I've seen firsthand clients selling because one example, an entrepreneurial client said, look, I need to put the money back into my business and I don't want the distraction of a liquid asset portfolio going up or down. So I've seen that. But generally people are stoical, and we've being able to point out, especially in the United States, so-called that Main Street, where the real pain in the economy is, it's quite different from Wall Street because, for example, the tech weighting up at nearly 30% now. Those are the kind of messages that we've kind of left with our clients that have resonated. But look, so far so good with the recovery. I think if we, for example, if we went back to new lows, it could be a very, very difficult conversation.
Thank you. Matt, how about at L&C? I know a few of your clients.
Yes, so similarly, a very wide kind of spectrum of clients. No two conversations are the same. I've had lots of those in the last few months. Obviously, you get that pocket of clients that their first emotional reaction is just to avoid any further kind of anxieties, and that they want to sell and have to kind of be reassured, as particularly if they're trying to do it at completely the wrong time. But I was actually surprised, even in the first couple of weeks, in the back end of March, how many people, both prospects and existing clients, were talking about the opportunities, who were looking through this and not necessarily dwelling on the kind of the anxieties or the uncertainties of the future. So a real mix. I think about this, and I wonder if the catalyst here, i.e. the health crisis, did feed in, makes this slightly unique in the sense that for some people it's an additional anxiety. They're not just worrying about their investment portfolio, they're worried about their family, their health, and so on. So that just accelerates their concerns. But then equally, it does put in context their own investment portfolio performance. There are bigger things to be concerning themselves. And I've had many conversations along that lines, where the conversation ends up, well, we're lucky, perhaps we shouldn't be too worried about what the investment portfolio is doing right at this moment. More recently, obviously, some logic, rationale has returned, and I do definitely get a sensitivity similar to what Alan said about particular types of clients, those that work in the real economy, who have businesses that realise about what the challenges that are faced over the coming quarters. They're the ones that are more pessimistic. Others, I'd say optimists are still in the minority, but I think those that are most sensitive to the challenges are the most pessimistic.
Well, the pessimists are being converted to optimists every day, it seems, because it's a one-directional market we have at the moment. Graham, your background's a bit different in the ETF business. I would like to know what are your thoughts on how this has affected sort of the trajectory and the movement or flows into ETFs. You know, has this changed what you've seen as what you would view as the normal trend pre-pandemic, or does it look different as we're sitting in the midst of this at the moment?
Yeah, I mean, I think that the short answer there is basically no. I mean, the trajectory is kind of remaining the same. I mean, you know, the ETF industry, there's plenty of press and headlines around it. You know, it's broadly 30 odd years old and has about a 6% market share. You know, and it probably will remain growing at 20 odd % CAGR. You know, so I think the growth of passive in ETF probably continues. And in some ways, you know, COVID-19 it has not affected that trend, and that trend will continue, as will, I think, the trend for illiquids and alternatives and off market, where and that hasn't, you know, really been impacted. I mean, maybe you know, we might see a couple of changes. I mean, similar to the global financial crisis, you know, ETFs were beneficiaries of some of those inflows. I think Alan was mentioning some of his clients he'd seen some inflows. It's interesting that when money needs to be deployed quickly, I mean, ETFs are a nice tool to be able to do that. There's no manager selection and some of the other admin. So they do tend to benefit from those flows very quickly. Do they remain there? That's more of a question of, you know, are there good alternative active and alpha products out there than anything else? But certainly in the short term, they benefit. I see that happening. Again, maybe this time round, one of the myths that's been out there is that somehow you know, ETFs were illiquid and wouldn't survive in some sort of market downturn. I think that myth has largely been bust. I mean, clearly liquidity of underlying instruments is liquidity of underlying instruments, and that hasn't changed. But certainly the robust infrastructure and nature held together. I mean, in fact, I think even the Bank of England were commenting in their interim financial stability report in May, actually saying that, you know, in fixed income products where there was no trading and was no liquidity, because ETFs are actually marked intraday and were trading, they were actually providing marks and valuations. So I think, you know, clearly valuations fall and NAVs go down, but the infrastructure held together. And I think that that overall macro trend, you know, the growth rates will remain as they will in the other side of the sort of the bell curve of investments in alternatives. You know, I think that doesn't change. And those overall macro themes which are driving this really, which is, you know, value for money, asset owners taking control, and this move towards digital transparency. You know, those themes are why you're seeing growth in ETFs, and that hasn't really changed at all through COVID-19.
Okay, there was a lot of, you reminded me because I had forgotten, there was a lot of nervousness around ETFs, particularly those with illiquid underlying in late March, well, throughout March for the most part. And I'm sure we'll come back to that probably, Graham, in a bit. But thank you very much for that. Petra at VAR, you guys do mostly public equities and public bonds. What type of message are you giving to your clients today on where they should be putting their money, both between equities and bonds, and then what sectors are in favor?
Yeah, so our asset allocation changed a little bit. As we discussed before, we are slightly more conservative. So our cash allocation is a bit higher than it would typically be or than it was last year. So most of our portfolios have about, you know, between 5 and 10% in cash at the moment, just kind of ready to deploy. And we have been obviously deploying over the past few weeks, but still have some decent cash positions. Then our equity, and I'm talking mainly about kind of medium risk portfolios. Our equity allocation hasn't changed that much. We are still around 50% in equities. And where we took some risk off the table is mainly in investment grade bonds, where we saw a lot of recovery, and especially in some of the short duration securities where we don't really see as much upside anymore. So that would be kind of the overall asset allocation. And then in terms of sectors, I'm going to talk mainly about equities because it is slightly different for fixed income. But on the sector front, there are potentially a few ways to answer your question, but from a strategic long-term point of view, and I think this is not going to really surprise anyone, but the structurally attractive sectors which have been in focus for the last few years, we think they will continue doing well and will actually become even more important. So your technology and communication services, working remotely, shopping online, meeting online, exercising online, it just makes sense to assume that these will continue being important. It's similar on the consumer front as well. Obviously, some of the more traditional staples companies will do well, but also the newer ones, food deliveries of anything, exercise gear, sports equipment, those companies we think will do well. So we have exposure there. Then on the healthcare front, obviously it's a bit more clear in the current crisis, especially during the race for vaccine or cure, but it's also more longer term, changing demographics, aging population. So it's not necessarily just the big pharma companies, but hospitals, medical devices, that's where we've been looking at as well. And I think it's important to emphasize that people may look at these sectors and think that they have already recovered quite a lot, or they've done actually really well throughout the crisis. Is there any point still getting involved? And we would say that it absolutely is. It's a long-term trend, not just a blip. Yes, there may be some volatility, there might be some wobbles quarterly, but we think you want to be exposed, and you want to be exposed a lot. And then the other answer for those interested maybe in some more shorter term tactical opportunities, and this is my personal view, but we do have select positions in these as well. Value stocks and cyclicals have underperformed during this recovery, and I think all of us here know it and maybe have felt it. But if you have the ability and maybe mainly the appetite to be a bit more tactical and nimble, getting some of the big cyclical exposure, big name cyclical exposure may be an interesting rebound trade. Some of the maybe big industrial defense companies, energy as a theme, or for example, some toll road companies, those are the sort of companies we have been looking at and buying. I just want to point out that we wouldn't build a whole portfolio around these stocks. Bulk would be the structurally attractive ones, but as a smaller pocket of tactical opportunities, we would be getting exposure there as well.
Okay, excellent, Petra. Thank you very much. Moving from publics and ETFs, Alan, I wanted to ask you about alternative assets. So gold had quite a run, and particularly during April up until just recently. There's real estate, there's private equity, there's all sorts of other off-the-run alternatives. What's Coutts' view or your view on do they belong in the portfolio? Which ones do you favor? And just your general view on alternatives, please.
Okay, so that's a wide subject. If we try and break them down a bit, I mean, private equity is equity. It's locked up equity, leverage equity. Still very attractive, arguably more attractive because of the interest rate structure that we have right now, and also the likely path of interest rates. It's hard to see Eurozone, UK, US rates going even above 1%. Even if we have a mini increase in inflation, I'm pretty sure the central banks will just ignore it, and therefore private equity is financing its debt at 0 plus a credit spread, so substantially lower. So one advantage of private equity is that you can't change your mind and come out and be tactical. You're in equity. I remember I think it was David Rubenstein from Carlyle was the first to admit that's the #1 attraction of private equity. You're forced, you stay invested, which is as we see in these times. So yeah, but it is equity. Real estate is an interesting sector. If you break it down into 3 areas, retail is actually in depression and remains in depression. Logistics or warehouses is in boom, and then previously offices were very steady. So the really interesting question is what's going to happen to offices, and it's very tempting to say the office is over. I wouldn't go that far, but certainly it's pretty hard to imagine companies doing huge new builds for a bit. And also offices maybe migrating more. Certainly we're thinking at Coutts at 440 Strand as making it even more of an event space than it currently is. But property looks, if you look at those three, it's only really logistics that is firing. So real estate looks a little troubled. And then we have gold, and gold is a great diversifier. It's volatile. It's good as part of the portfolio. As it happens, in all openness, that our tactical team is out of it right now, looking to get back in. But let's talk bigger picture. I mean, bigger picture, it does provide great diversification. So different types of alternatives there. And then finally, I probably end on, which is, you know, the holy grail that we all want, Petra, Matthew, and I certainly is something different from equity. It's very easy to buy equity. So something that's a diversifier. So gold offers that to a certain extent. Fixed income has till now, or high quality fixed income. And then we're looking at alternative funds, the classic hedge funds that are either explicitly have a negative correlation with equities or are some kind of market neutral. We continue to look, but that's been a tough space, a really tough space to deploy our capital. We've got a few funds that we can allocate to, but really a lot of the market neutral funds have disappointed. So to sum up your question, Tim, I think it's really out of those alternatives. Private equity, of course, great, will remain so, but that's return-seeking asset, and then gold as a hedging asset.
Okay, thank you very much. I should have, one other I wanted to ask you about, I hate to drift into it, but I'm just curious, private debt, because, you know, debt funds and these private direct lenders came into vogue. I personally have some concern about them in this environment, but I'm just curious as to whether or not you're moving clients or clients are speaking to you about what's happening at these direct lending firms in this environment.
So we don't allocate in this space. We have allocated to loans, but more large company senior loans. In fact, you could think of it as senior private equity that we've allocated to. But this direct lending, a lot of our clients have been quite seduced by the high rates on offer. And part of it is behavioral, because these types of portfolios or loans are not marked unless they've gone sour. They're kept at par. And so there's this low volatility, which I think is an interesting subject. Nearly all clients I come across want that holy grail of return with ultra low volatility. And that's led them to some of this direct lending, either directly or funds. And for me, it's, if those loans were marked to market, they would have been down 25-30% in March.
Yeah. Okay, thank you very much. Matt, I'm not wanting to drift off the topic of L&C and financial institutions, but I was wondering, do you have a response to that at direct lending? I don't know if L&C moves some of their clients or has discussions with their clients on direct lending, but I'm curious. And then the real question, of course, the second part are financial institutions. You know, this has not been a financial institutions crisis. There was a lot of pressure on financial institutions initially in the early stages of this pandemic, and they generally recovered. You know, I think you have to pick your spot, so to speak, but I'm curious as to what L&C is thinking about financial institutions these days. But you might want to start and follow up with the question I asked Alan on direct lending.
Yeah, so I mean, we have historically looked at some what I would call like alternative income strategies, but only in a very small way and for portfolios and investors where it's suitable for their risk profile. And as Adam points out, you know, it has come under pressure because, you know, even though these things might be backed by assets or revenues or cash flows or whatever it be, whether it be aircraft leasing or trade finance, or whatever it be, commodity finance, they've been impacted by the shock. But this is where, you know, when you're constructing a portfolio and you know that there could be these risks, that you budget accordingly. And like, you know, the fact is that same yield that could be seducing other people tell other investors that there's a risk that underlies it, and then that has to be sized accordingly. In terms of your question for financials, so financial bonds, not equities, have been a core part of our portfolios over quite some time, you know, many years. Main reason for that, and we focused on the sort of globally systemically important banks and national champions, none of the peripheral banks and so on and what forth. And the main reason for that is that post-financial crisis, obviously there's been a big push to regulate, to make banks safer entities, to change their business models in some respects, make them more transparent. And what this translates to from a regulatory perspective is that they're being forced to increase both the quantity of capital and also the quality of the assets that they're carrying. So they're being pushed to being almost like utility-like and not the pre-financial crisis businesses that they were before. So we felt for quite some time that that's been an attractive risk-reward for investors, and that's been the case. Obviously not great for stockholders necessarily, because the return on equity is being suppressed, and profitability hasn't been there. But for debt holders that are sufficiently rewarded, we've seen that those gains over time. Obviously, banks are economically sensitive, and regardless whether you're in the stock or in the debt, or subordinated debt, or senior debt, whatever you're in. And so we've revisited that in recent months, as you would do with any sort of good risk management process. And our analysis is that yes, there will be some impact on capital, on regulatory ratios, on the quality of their assets. That's inevitable with the economic impact we're seeing. But the state that banks are in now puts them in a far healthier position to be able to weather that. And this is consistent with the stress tests that central banks have done, and kind of the scenarios that have been run there, which are even more severe than during the financial crisis. So banks have almost been prepared for not a COVID shock, but for an economic shock of very significant proportions. Yeah, I mean, our view remains intact. There will be volatility, because of the economic sensitivity. But when we're addressing the underlying credit risk, it puts us the regulatory impact. So the impact of regulatory ratios is going to be manageable, and therefore we're comfortable with running it still in our portfolios.
Okay, thank you very much. Just to interject, oh, sorry.
So I was going to say, maybe just taking a step back, because obviously it's got a bit of ratios and all this sort of stuff. I think it's probably worth stressing that this isn't a banking crisis like the last one. Right. In fact, actually, banks are absolutely essential to bailing out the real economy, and we can see that that's in the mind of policymakers in what they're doing now. And certainly for debt holders, the moves that have been taken in terms of adjusting kind of regulatory measurements to either leaning or forcing on banks to curtail buyback programs and dividends and variable remuneration, that all creates a buffer, a cash buffer for debt holders, which makes us again comfortable.
Yeah, I agree, absolutely. I remember how miserable it was in the Great Recession, not only being in banking but being a banker in general. So it was not a pleasant time, but different crisis, different cause this time. Okay, so just as a reminder to those listening in, if you have any questions, you can click on the bottom of your screen and send them to me, and we will address those post the formal part of this presentation. So the next question for everyone is your thoughts personally, or what your firm is saying at this point on the recovery. What's it going to look like? There's all of these, of course, discussions around whether it's U-shaped, V-shaped, W-shaped, reverse checkmark shaped. I mean, I've heard probably every possible shape that you can come up with, and not only the trajectory, but also the timing. So we're seeing, of course, a market that is acting, in my opinion, so this is the moderator's opinion, not the panelists, like this crisis never happened. It's actually remarkable to see. People are looking way out there, it seems to me, but I'm really curious as to what your thoughts are yourselves, given that you're involved in these markets every day. Graham, is it okay to start with you, since you've been silent for a few minutes, and you're at the top of my list here.
Sure. Although maybe someone else will be at the top for the next question. That rotates around. Whatever. I'm no happy to address that to the extent. I guess my point of view and starting point in this is maybe slightly different from your other guests, and really there's a couple of things. I think number one, one of the impacts of this crisis that will be different from the last one, the acceleration of the values that we are placing on our investments. And in particular, this is manifesting itself in things like ESG investing. So I think that's going to be something that's accelerated and materially changes. That probably drives investor behavior and accelerates some of those other trends that I mentioned before, the kind of the value for money, taking greater control, and even how investments are made. So my background, and as explained, is really in building the platforms to service this. But what I do think we will see is a changing perspective and changing demands and needs. And that ultimately is going to drive, how investments are made. In terms of what a shape of a recovery is, then I think I'll leave that to your other panelists who are far better placed to answer that. But that's my thoughts on the subject.
Okay, thanks, Gran. Petra?
Yeah, it's a difficult question to answer. It's obviously something we discuss internally a lot, and frankly, that view keeps changing. And I think everyone has potentially slightly different views on it, just because, and I know the word unprecedented has definitely been overused, but in a way it is. At the moment, I would say our internal consensus is that it is unlikely to be a completely V-shaped bounce, unlike what happened in the market. And I think that's also no longer the market consensus. We did think that back in March, which we no longer think. So to us at the moment, it looks more like that Nike swoosh shape. So slower recovery. It might take a bit longer to get back to normal in many economies and many industries. I think it will also most likely not look obviously exactly the same in all countries. The UK might be especially a bit different in the light of Brexit, etc. But let's see how that pans out. And one of the shapes that has been discussed a lot recently, or our clients have been asking us as well, is the L shape, or the 90% economy, suggesting some permanent scarring in the economy and not being able to return to previous levels of growth. We are not really that pessimistic at the moment. We think that it might take time and the economy may look different. Different sectors may be the leaders, but we think, hope that growth will return, and it may be slower on the back up than we initially thought, but hopefully it will recover.
Okay, thank you. Matt?
Yeah, I would say, our view is that it probably looks more like this elongated tick or Nike swoosh, as Petra said. I think that a V-shaped recovery, given the a symmetrical V-shape, given the collapsing growth, probably looks unlikely. It would rest on the assumption that consumption comes back very quickly, and we don't have second waves and all these things that could prove to happen, but I think it's unlikely. I think that maybe the narrative around this is going to change quite a lot over the next couple of months, because obviously you lift lockdown, people resume then some of their normal activities. You can have some pent up activity and spending. You might even get some celebratory spending that leads for kind of a quick retracement of some of that lost aggregate demand. But I think that is in time, several quarters down the road, maybe, or a couple of quarters down the road, that the tough parts, and Petra spoke about the 90% economy, that last 10% that is going to be difficult sectors, difficult for certain industries. We're going to find that consumption, maybe there are questions about the patterns there, whether households are going to save more, spend less, go out less, whether some of that temporary unemployment becomes permanent unemployment for certain sectors. And so that there's going to be, later on down the road, there's going to, in order to get that get back to where we were at the end of 2019, I feel that that's going to be the difficult bit to fill, where people are going to be focused on their balance sheets and cutting back, not on getting back that last 10%. In terms of timelines, I mean, I think realistically we're looking well into the back end of 2022 and probably 23, to be honest, before we get back to that level of not growth, but the level of economic activity that we had before.
Okay, thank you. Alan, how about on your end?
Okay, well, maybe I will say something different. If we knew nothing and just looked at historical data, it will be a V shape. Because remarkably, it's always been a V shape. And I'm talking about the economy, not markets.
Yeah.
So step one. And also, I do think, you used the word unprecedented, I think that is right. But it's very specific recession. It doesn't have the mystery of 08, 09 with CDOs, AIG, our bank's going to survive. It's very specific in hospitality, leisure, and retail. And so I think there is logic, as Matthew said, in terms of some kind of euphoric V shape to start with. In fact, even, I hate shopping, but even I might go to a shop when the shop's open. Just, why not? So I can see that. I think the longer term, what does it matter for? It doesn't really matter for equities. Why? Because equities are long duration assets, ultra long duration assets. It matters for one component of equities in particular, value, because value is associated with the economy. So if we do get this initial V shape, which it looks like we are getting, that's some evidence from China, then we can see, going back to what Petra was saying, value stocks have their day in the sun. I do agree it is only probably a day in the sun or maybe several quarters in the sun, but it could be quite violent because value stocks have got very, very cheap. But going back to the real economy, so what do we see? Look, V shape, yes, but then just like after the financial crisis, slow growth. And this time as individuals rebuild their savings ratios, arguably we're seeing some of that already, and companies are likely to be on the cautious side in terms of whether it be M&A or capital investment. But, as you say, hardly anyone expects a V, so let's go with the V.
Okay, I like an optimist. It's good. Okay, last question for you all. I can't help but ask, the global economy, in spite of the discussion we just had, it's obviously the second quarter is going to be the worst and worse since the Great Depression, if not worse. I mean, it is a lot of bad economic news on the horizon. The stock market is rallying everywhere. It feels like day after day after day. It finds resistance levels very quickly. I've seen many times when the futures are down overnight. The market opens a bit down and pops at the end of the day, and it's just incredible to watch. I have difficulty digesting it and understanding it. So I'm going to go to our panelists and ask them, how in the world, with this dire economic data staring us in the face, can stock investors, equity investors be so, and for that matter, credit investors as well. If you're watching the credit markets, the spreads are also screaming in, some attributable to the Fed, arguably, the central banks generally, not just the outlook. But how can the market be so optimistic with this news so dire coming in the second quarter? Who wants to start?
I can start.
Okay, thanks first.
Sorry. So I think there are a few factors. Obviously, they play part. Some people argue that the market is always forward-looking and that the past and present don't matter. I mean, to some extent, I guess that is the truth, but it's definitely not the whole picture. And I think it goes back to what Alan was saying a bit earlier about a very important factor, and that is the composition of the market and how different the Main Street is actually from the Wall Street. So when you look at the composition of the market, and for the purposes of our discussion, let's talk about the S&P 500. You can see why there has been the disconnect. S&P 500 are the largest 500 companies or publicly traded companies in the US. They are profitable, they are cash generative, they have healthy balance sheets, they are diversified and global in their reach. And very importantly, more than 50% of the index is in big tech I mean, the combination of technology and now the communication services, which is the big tech companies, and healthcare. So it is a lot less cyclical than it used to be. And as such, it doesn't really represent the smaller struggling companies, and there really is not that much correlation between the winners and the losers of the economy. Obviously I'm already thinking of dinner, and the losers of the economy. So I think that is a really important factor, and that's something that we have been really focusing on, and that's why we stayed in the market. Longer term, obviously, the economy is a factor, but it's just one of the factors. And then lastly, liquidity, and that has been supported massively by the central banks globally. It also dictates the market direction, and that has been very powerful. And actually, interestingly, this is actually not a new trend. This has been the case for a really long time. But someone just sent me a very old Franklin Templeton investment newsletter or letter from the 1950s, where they were addressing exactly this question, why the market is doing so well when the business conditions are actually doing pretty poorly. It was, I think, from 1958. And the answer even back then was very similar, and that was that business conditions is just one of the factors, and number two, liquidity and central banks are a very powerful force. So I think all of these would probably be my answers as to why it's disconnected, but I'm sure there are other factors as well.
Thank you. Who else?
I'll step in. Obviously, we understand the rebound. You know, at the end of the day, in terms of where we were in March, some good things have happened. Lockdowns have worked. That wasn't always taken for granted, and got on top of that the health crisis. You've had a very robust policy response that's put a kind of a floor in growth expectations and avoided some of the sort of tail risks that could have happened for the economy. It's some of those similar policy responses have, at the time, we were getting some dysfunctional markets. I think somebody mentioned fixed income liquidity, you know, and dollar appreciation pressures. It's eased some of those cascading risks that could have taken place. And then there is the question of it's so sizable that it has and we've seen a huge collapse in yields. This has driven asset prices on a sliding scale, and this is not something we're unfamiliar with, because it's been happening for quite a lot of the last 12 years, stop-start. So I think people are surprised by the disconnect this time between market indexes and the real economy, because they're feeling it. And you know, I have some sympathy for that, and I don't think that we can go on indefinitely with that disconnect. I think that earnings eventually have to be restored to a position where they validate the valuations. But I think it really comes down to the aggressiveness of the policy response and what that's done to yields and the relative attractiveness of other assets. That kind of made people, given the justification for thinking that, okay, I can pay high multiples. I think Alan said it earlier, you know, at the end of the day, on a relative basis, other assets are equally overvalued or unattractive, and therefore equities become the go-to place.
Thank you.
Shall I jump? I think it's, I agree with many of Petra's and Matthew's points, but I think the answer probably lies in Wharton, actually, Finance 101, the discount rate. We are now discounting those cash flows at ultra low rates. And more broadly, the people or the type of analysis and the analysts themselves who've got equities broadly right, ever since the financial crisis really, have been the ones that have focused more on the interest rate component rather than, for example, CAPE, cyclically adjusted price earnings ratios, or price to book, or even price earnings ratios where equities have looked elevated. But focusing on that discount rate has been correct leading up into this crisis. And I think it's correct now. And if you look at kind of where we are, we've got, actually I was looking just now, Russell 1000 growth. So growth orientated equities in the US, including some mid-cap companies, are back to all-time highs. And that makes perfect sense based on Finance 101. You're discounting very long-term cash flows. In contrast, if you like, where Main Street meets Wall Street, it's value investing. Value investing is shorter term cash flows. That's where the discount rate is less important. That's where the real economy really matters. That's where you're relying sometimes on dividends or sometimes price earnings ratios changing from 7 to 8, something very kind of short duration, if you like. And that needs the real economy. Interestingly, as we speak, just in the last couple of weeks, it looks like value stroke cyclical stocks are moving to discount this mysterious V-shaped recovery that I've, just propagated. So for me, go back to, in summary, Finance 101, discounting those cash flows. What every private equity firm looks at, they look at the long-term cash flows, they use a discount rate. Well, look what the discount rate is today. And by the way, it's unlikely to go anywhere for years. It's going to be ultra low. When the dust settles, people will focus on, wow, from a more practical point of view, I'm earning 0 on cash.
Yeah, I mean, thank you very much, Alan. Somewhat related to that, just as an aside, for those of you that were at the Wharton virtual reunion, I should say, a week or two ago when Jeremy Siegel spoke, who's one of the esteemed finance professors there, he was very clear on saying when you're looking at discounted cash flow models, even if all companies earn 0 for the next 4 quarters, their value would be down somewhere around 10%. And you can do the math at any interest rate, he said. But, to me, this market is looking forward. That's the main thing. It's not about the next quarter or the quarter after that. It's about where we're going to be next year at this time. And that seems to be very much becoming more resonating more permanently in investors' mind in this environment. Graham, do you want to add anything on that?
Yeah, no, the only sort of observation that I would make, obviously 2019, you had a 30% return from US equities, and pre-COVID-19, we were full of talk of $2 trillion of underinvested PE money and obviously, the pressures and strains on valuations. So I don't think, when what we see and when possibly where the V-shape and possibly where the flows to ETFs come from, the moves back into liquid assets are just easier and possible. I do think this demand for fundamental and differentiating assets in the alternative space will also increase, but it's hard to find, it's hard to invest in, and actually in many ways there's almost a concern for how the industry responds, but by opening the doors to these investments because of the demand from investors, whether or not this will end up being good value propositions for them. But I think that's certainly something that we would see this kind of sort of bell curve of investing and behaviors as an ongoing theme, I think.
Okay. All right, thank you very much. We do have a few questions, so I thought I would, I've looked at them and have a order of preference. I guess that's my prerogative as a moderator. So the first one for the panelists are, in your opinion, is this stimulus coming both from the central banks and the governments sufficient? Now, it might depend on, of course, whether you're talking about the Eurozone, whether you're talking about the UK, the US, Japan, and so forth. But in general, what are your reflections on the magnitude of stimulus at this point, both from governments and from central banks? Petra, do you want to start?
I mean, obviously the size of the stimulus everywhere has been huge. Is it enough? I think we will have to see. But yeah, I don't really. I mean, obviously, in the EU, I know that they're talking about additional recovery fund, which hasn't really. We haven't really seen the details of it or the final agreement of it yet, but it looks like it's going to be a substantial or again unprecedented in size. I can't believe I used that word again. But yeah, I think there will be. other things that the recovery will depend on. But in terms of the size of the stimulus, yeah, you're right. It depends on different countries. In the UK, I know that the market is expecting even more, or pricing in even more, and potentially in Europe. So I think if we don't get more, maybe in certain markets, we could see a bit of volatility. But from an economic point of view, I think it, you know, it is huge. So yeah, I think it is.
Anyone else want to take a shot at that?
Yeah, maybe. I certainly in terms of commitment, I think that is being very significant. I mean, I can't answer the question about if it's large enough. I mean, it's been large enough for markets so far. You know, probably the only thing you can say in terms of reassurance. I think when you aggregate kind of the global fiscal policy packages, we're talking about in excess of 9 trillion now, and for a 86 trillion global economy, that's a pretty big swing of the bat. And we'll go some way to filling that hole over time. And obviously it's got us through this period where there was a complete collapse in cash flows for many people. And that's what's led to this kind of very committed approach and the unique shock that we've had. And I think people may ask, or clearly, you know, Petra's suspicion is that this is not the last of it, you know, in the sense that if there are no immediate negative consequences, people are asking for it and politicians are willing to buy into it, regardless of whether or not it makes a good economic or long-term sense. I think that they'll do more and solve the problems, solve the problems they have in the short term.
Yeah, just something from me in terms of central banks. I think in central banks in particular. So 2 aspects: buying government bonds, essentially replacing the issuance. I mean, there's huge demand, not really a risk asset, more a hedging asset. What I find interesting is that it's criticized by a lot of commentators when they buy risk assets. So that's typically been credit for the first time by the Treasury. The Fed is implementing that for the Treasury in the US, or the ECB buying credit, the Bank of England. I think, interestingly, the central banks are very successful. And we can even go back further. In 1998, Hong Kong Monetary Authority bought equities, Hong Kong listed equities when the Hong Kong dollar was under attack. And again, successful. And you have to ask yourself why. It was very simple. Above average risk premiums, credit spreads were above average. And if you invest, and in the time of Hong Kong equities were cheap. When you buy assets which are cheap with above average risk premiums, as the central banks have been doing, it's been successful. Now, without the central banks, what would have happened? Well, eventually they would have found a bottom, and long-term institutions, maybe quiet institutions like the likes of Warren Buffett or sovereign wealth funds, would have replaced, if you like, these central banks and bought these assets. But the central banks have come in and preempted it, and those of a more libertarian stance might regret that, but all they're doing is buying attractive risk premiums that we all should be doing, frankly, and not getting caught up in the noise and the narrative of the news.
Okay, well, we'll find out, of course, tomorrow in the Eurozone what the ECB is going to do. I mean, it looks like the market is saying they're going to expand at least the scope of their QE, if not the amount. But this is again just a personal reflection from the moderator. You know, my feeling about fiscal stimulus coming from the EU is it couldn't happen soon enough, and it's not going to happen for a long time, though, given the dysfunctionality generally in the process for getting fiscal stimulus approved. One other related question, which I think is a good one, and then I have 2 more questions. There's others on the list, but I'm going to ask 2 more. This raises the issue of inflation. So we haven't talked about inflation today, and you know whether or not really what we're getting is a dose of modern monetary theory with this fiscal stimulus and the central banks not monetizing it, but de facto they're ready to to soak up the the issuance by the various treasuries. What does that say about inflation down the road? We avoided it after the Great Recession, after I think there was an expectation for probably 2 or 3 years that it was coming. It didn't materialize. What about with this dose of monetary stimulus? And you guys, it's a free for all. So whoever wants to go first, rock on, and let's hear what you have to say about it.
Well, I mean, relative to 2008. Sorry, do you want to go, Alan? Sorry. It was the unnerving silence. I didn't like it. I think relative to 2008, the chances are higher than that we see a dose of inflation in time. Obviously, what we're experiencing now is a disinflationary shock, and that's going to be the case for the next 18 months, 2 years or so. But looking past that, key reasons, I think, obviously the size of the central bank support, the aggressiveness is very larger than it was, and the tie-up between fiscal policy, the fiscal dominance of monetary policy, almost you could phrase it, into soaking up that debt. The other key things I think are important here, coming back to my talk about banks, is that banks are going to be a better transmission of credit to the real economy this time around. What you had before was central banks creating monetary base and commercial banks simply destroying credit, after the financial crisis, through curtailing the lending and so on, because they're in such bad health. You don't have that this time. In fact, actually, governments, policymakers are urging banks to lend more. So I think that transmission mechanism is more intact and could raise the prospect of inflation. The other thing is that maybe one of the outcomes out of what we're experiencing at the moment, the political ramifications, is we do see a rollback of globalisation. And that's clearly been a secular downward pressure on inflation. If we see it reversed, then maybe give us an uplift. So yeah, I think there's the potential for higher inflation, but there was a reason why it was so low and stickily low for so long, and not all of those reasons have gone away.
Yeah, so I was just going to say, it's very hard to get any evidence for higher inflation. It's very hard to generate. It's been very hard to generate inflation in Japan for 20 years with ongoing QE, just because, if you like, the Fed on behalf of the Treasury rings up, I don't know, CalPERS pension fund to bid for treasuries, doesn't generate inflation. There's no ongoing bank lending because of that. Obviously, it does restrict the supply of treasuries when it comes to the most basic QE. And wherever you look around the world, there's very little evidence of higher inflation. Even here in the UK, with a currency devaluation and traditionally a higher inflation country, it's very hard to generate inflation. So there's something we don't quite understand, whether it be Larry Summers' secular stagnation, demographics, we don't fully understand. But even more important than actually inflation is that, let's say I'm wrong and we have a little bit of inflation. What will central banks do? Nothing. They will just let inflation rise. Rates will stay deep negative in real terms. That's what's changed the most. I think people appreciate we're in a low inflation world, but we're in a low real yield world. Pre the financial crisis, the norm was 6 rates, 3 inflation, ballpark. Now the norm is 1, 2 inflation. Okay, we're lower than that now, and 0 rates. It's been like that in the Eurozone for years. So the idea that if inflation picks up to 3, that a central bank's going to raise rates, I find that very unlikely. So the message from us is ultra low rates here to stay, and we just don't see any evidence of higher inflation.
It's actually similar for us. So I think we would agree with Alan and his views. I think in theory, I see where Matt is coming from. Obviously, globalization is maybe, well, it's not ending, but it may be changing to some extent. Obviously, the monetary push, again, in theory, over the next 2 years could be there, but we don't really see the actual reasons for inflation to go up massively. I mean, there may be a little bit of inflation, but we don't really see a huge push for big inflation. So more worried about this inflation for the next few years, and then afterwards, again, probably just low inflation.
That was me. Graham, sorry about that. Do you want to add anything there, or I can go to my last question?
No, I think conscious of time, actually, we're on the hour, so why don't you just jump to your final question?
Okay, the very last question that was asked is, someone reminded me that there are probably a disproportionate amount of Americans on this call. Any advice for the Yanks?
Matt is probably
in terms of
place
market.
for that.
Sorry, I don't mean generally. Sorry. Any
Can I be a bit more specific?
sorry, any specific recommendations or changes or comments that you might want to add in closing, knowing that there is a skew towards Americans on this call?
Yeah. Okay, so I think that pre-COVID, there was obviously a period of US exceptionalism in terms of financial markets, and that be whether that be dollar appreciation, better levels of growth, healthier, more balanced stock markets, etc., etc. I think higher risk-free rates. It was a better place to be. I don't think we can take that for granted now, because obviously we've had a reset in growth, reset in interest rates, and maybe if we do see more of a level playing field, that some more international diversification, which a majority of Americans that come to, that's not a huge part of their portfolio, quite rightly, because of the universe that they operate in. But then also the fact that I think this, over time, once this recovery gains traction, we'll probably like to see the dollar start to depreciate, and that be a function of the fact that relative balance sheet expansion globally from central banks, capital flows, but then also because it's absolutely necessary for the recovery to take place. So the US will want it, and the world will want it. International partners will want it. So maybe that's one piece of, that's what we can do for the Yanks.
Okay, makes sense. Anyone else?
Very quickly, so just on the currency, so the US dollar has been supported by a lot of carry in the context of a low interest rate regime, in the sense that it has been 2.5% rates, whereas Eurozone has been negative, UK also very low, and that carry has been important in a environment when rates are low everywhere, just the carry component, and that has now gone away finally with US slashing rates. So I think investing from a dollar base to finally make some money in non-dollar currencies looks to make sense to me.
All right. All right. I'm presuming that we are out of comments. The panelist was outstanding. It was terrific, guys and lady. I really appreciate all your comments, and I think the Wharton community here very much appreciated and learned a lot from this. So thank you so much for spending an hour of your evening to join us. And on behalf of the Wharton Club of the UK, we appreciate it, and we close this webinar. So thank you.
Great. Thanks for having me.
Thank you.
Thanks.
Thank
all.
you.
Good evening.
See you another time. Bye now.
Good evening.
Bye.